Good morning, this is your daily briefing for August 7th, 2026. Today, two questions connect technology and markets. Could artificial intelligence make everyday goods radically cheaper? And does the latest rotation into precious metals signal durable demand, or merely another violent rebound in a volatile market? We begin with Mark Moss. His newest video responds to Elon Musk's prediction that money may matter far less by 2036. Moss agrees that artificial intelligence and robotics can reduce the cost of producing many goods, but argues that physical bottlenecks and government obligations will keep scarcity, prices, and financial assets relevant. Musk's date is a prediction, not a verified forecast. The useful part is the mechanism behind it. Automation can increase output per worker and reduce the marginal cost of manufactured products and digital services. But greater productive capacity does not mean every household expense falls, and it certainly does not prove that money becomes obsolete within 10 years. The physical constraint is real. The International Energy Agency says global data center electricity consumption is set to roughly double by 2030, with AI the most important driver. It also warns that grid connections, transformers, turbines, advanced chips, and approval delays are already limiting expansion. That supports the source video's narrower claim that power, cooling, and infrastructure can matter as much as software progress. The fiscal argument also has documented foundations. The 2026 Social Security trustees project the retirement trust fund's reserves will be depleted in the fourth quarter of 2032. Continuing income would then cover about 78% of scheduled benefits unless policy changes. Separately, the Treasury's fiscal 2026 estimate puts interest on the public debt at roughly $1.3 trillion. Those figures do not prove inevitable money printing, but they do show why faster productivity alone cannot erase obligations written in dollars. Moss also argues that technology-driven deflation can coexist with rising living costs. That is plausible because prices do not move together. Electronics and information services may become cheaper or better, while land, housing, healthcare, energy infrastructure, and other constrained services remain expensive. His conclusion that all productivity gains flow mainly into asset prices is an interpretation, however, not a universal economic law. That distinction matters for his investment takeaway. Land, natural resources, companies, and Bitcoin have very different cash flows, risks, legal structures, and supply dynamics. Calling them all scarce does not make them equivalent or guarantee appreciation. The source's preference for scarce assets is opinion, not personalized advice, and any return forecast remains uncertain. Now to FX evolution. Its latest market video highlights a sharp rebound in gold and silver, fresh highs in major United States indexes, improving market breadth, and continued weakness in parts of semiconductors and crypto. The presenter describes this as rotation inside a resilient but unusually jumpy market. The broad gold story has support, but some details need caution. The World Gold Council reported first quarter 2026 total demand of 1,231 tons, with official sector purchases above the previous quarter and the 5-year average. It also reported strong bar and coin demand in China and increased retail demand in South Korea. That does not independently confirm the video's specific claims about new Korean central bank purchases or restrictions on bullion exports, so those claims remain unverified. On equities, the source points to strong earnings revisions, broader participation, and new highs as constructive signals. Those are reasonable market observations, not guarantees. A rising index can continue rising, but historical averages cannot predict the next drawdown. Likewise, dark pool prints and options levels may identify areas of interest without revealing who traded, why they traded, or the direction of their full position. The video's most useful warning concerns volatility. Large single-session moves in mega-cap shares can reflect changing information, crowded positioning, or uncertain valuation. They are evidence of repricing, not evidence that a crash is imminent. The source compares the behavior with earlier late-cycle markets. That comparison is an opinion and should not be presented as a forecast. For the practical watch list, focus on 4 things. First, breadth, are gains spreading beyond a few leaders. Second, earnings revisions, are company forecasts still improving? Third, credit conditions, are borrowing costs and spreads signaling stress? And fourth, the physical AI build-out, are power and infrastructure constraints slowing spending? These indicators can test the narratives without pretending to time the market. The combined lesson is that abundance and scarcity can advance together. AI may lower some production costs while increasing demand for electricity, grids, land, and capital. Gold may benefit from hedging demand while remaining volatile. Stocks may reach records while individual sectors weaken. Separate documented facts from predictions and treat every confident market conclusion as a claim to test. This briefing is general information, not financial advice. Both source videos used machine-generated English YouTube captions. No translation or whisper fallback was required. The source videos and independent verification links are in the description. Thank you for watching.